This episode of Startup Insider is made possible by the Entrepreneurship and Innovation Working Group of the Finger Lakes Regional Economic Development Council, Complomar Partners, a market-leading global supply chain provider delivering logistics and packaging solutions, the Technical Entrepreneurship and Management Master of Science program at the University of Rochester, and this episode's featured sponsor, Excel Partners, a Rochester-based national leader in seed stage venture capital investments.
Hello and welcome to another edition of Startup Insider. I'm Zapesochny. Today's show is important because we're going to be looking at a topic that's also very important to entrepreneurs. What is it that entrepreneurs should actually know about angel investing? What should they know in order to get those investments? And what sort of mistakes do entrepreneurs make in actually getting those investments? We'll discuss this and many other topics with a highly experienced group of panelists, each of which represents a different set of viewpoints and understandings about this topic. Our first guest today is Don Golini. He is chairman of the Rochester Angel Network. In addition to his leadership at the Rochester Angel Network, he manages the Rochester Institute of Technology's Venture Capital Fund. And Don previously also founded and successfully sold, that's an important distinction, a high-tech company. Welcome to the show, Don. Our next panelist is Mike Totterman. Mike Totterman is CEO and co-founder of iCardiac Technologies. Mike is actually a former venture capitalist himself, and he is a serial tech entrepreneur, and he has also made angel investments and has also raised money from angel investors. He's seen it from all sides of the table. Welcome to the show, Mike.
Thank you.
And our final panelist is Ed Schreyer. He is CEO and co-founder of Qmetrics Technologies. Ed has held senior leadership positions at successful companies in Silicon Valley and in Rochester, and he has raised investments from multiple angels located both within and outside of the Finger Lakes, Rochester area. Welcome everybody to this topic about angel investing. And let me start off with you, Don. Can you tell us a little bit the basics? What is an angel investor, especially what is an organized angel investor, the kind that you lead in our community?
Sure. So angel investors are really just individual investors. They're individuals who are interested in putting money into early stage companies, usually growth-oriented companies. And the most typical angel investor is someone who's started a company and successfully exited so that they have some discretionary money to invest. I would say they don't primarily look at the investment as solely a financial investment. Of course, they like to make money, but they do angel investing primarily because they love the space. They love working with entrepreneurs. They think that they can help the entrepreneur. They want to get hands-on and involved when they can, when it makes sense, when they think there's a good fit. And of course, they've experienced the growth and the excitement that comes with growth-oriented companies, so they'd like to still stay in the game. And of course, when they put money in, they expect to get a good return also.
Now, one of the things I know we want to talk about is the different motivations. So the kind of angel investors that you're talking about are individuals who are oftentimes investing in the companies of strangers, potentially. They have all sorts of motivations. But there are many different other types of angel investors. And maybe, Mike, can you start off telling us about what are the other kinds?
Sure. And I've had a fair amount of experience with this. It's really kind of friends of friends of friends. So folks that have usually one of two linkages to the company. One is they may know the space really well, but secondarily there's some type of a personal linkage. It could be they know a board member, they know the founder, they know the CEO, and what they're really ending up doing is backing the individual as much as backing the space.
And are there other motivations or other bases upon which people become angel investors? I think that's actually quite applicable to your current company.
Well, Alex, I think Don kind of alluded to this. I think there's a pay it forward sense where somebody's been successful and they feel maybe a civic responsibility to help other struggling entrepreneurs get that first break that will help them ultimately be successful. So I think to what Mike said, they're really not professional investors. These people are people who care about the individuals or the space. They understand the business and they want to help.
And where do you typically find these various types of angel investors? And maybe go back to you, Don.
Sure. So I think the Rochester Angel Network, I think formally came together in 2005. But I think people in this community have invested in early stage companies for a very long time individually. When the group formed in '05, it was really to try to formalize and give people some visibility as to where they turn to get these investments. So it's not just about personal connections. A lot of young entrepreneurs haven't had the opportunity to network with wealthy people. They don't know where to turn to get their investments. And by having a formal network, there's a place to turn, and there's a process to go through to get that money. So when the networks have come together, and you see all over the country and all over the world, literally, angel investing and angel investment networks have really begun to mature and are much more formal than they were, I'd say, 20 years ago. Today, what the group does that's a little bit different is they'll band together and they'll do screening. So they'll look at companies as a group, and if the company meets certain attributes that make them look like they'll qualify for an investment, then they'll invite them to come to a larger group, the entire network, and do their pitch. If a majority of the people that hear the pitch like it and want to learn more about the company and go through a due diligence process, that initiates another stage of investigation. A smaller subset would get really involved in the company, learn a lot about the company, ask all the hard questions, and ultimately they come back to the group with either a recommendation for investment or not. At that point, individuals are still making the investment by and large. So the group doesn't invest as a group. They evaluate deals as a group. They meet entrepreneurs as a group, but they ultimately cut the check individually. And that's the primary form of angel investing.
Now, one of the questions I get asked quite often is, okay, there's the Rochester Angel Network, but there are all these informal other networks that are still out there, and many people say, well, I don't know. How do you get there? And actually, Mike, when you and I were working at iCardiac, there are all sorts of ways to get to these informal networks. I mean, can you maybe talk a little bit about the power of weak bonds, perhaps?
Yeah, no, I think that's a really important component. I think it's a really important component for entrepreneurship in general. It's really about being able to tell a compelling story and exposing as many people to the compelling story as possible. And I think at iCardiac, what we did is, if we look back at the kind of the angel investors that invested in it, there's a group of going all the way back to friends of friends from high school who you stayed in touch with, who understood that and saw your career growth over time, that trusted you. They put money into the transaction. They said, I've got some friends who work at high-tech companies, may be interested in that. There's another collection of kind of friends and friends of friends from college and academic institutions, whether it's undergraduate or graduate. So I think an entrepreneur's story arc is usually, it's kind of a multi-decade story arc. I mean, this stuff gets started very, very, very early. So I think one of the key things for an entrepreneur to do is to network as broadly as they can and demonstrate along their career path that they can add value and they're serious about what they're doing. Then when the time comes to look for investment, it's a lot easier to go to that network and have folks refer you to other folks that may be able to write checks. So then angel investing is really about making the calls to the individuals who've believed in you all along the way rather than some type of a different effort.
Well, and sometimes, and maybe Ed, you can speak to this, people don't necessarily think of their network in a complete sense. There are probably individuals that are perhaps part of accounting firms, law firms. If you're a student, there are professors who sit on all sorts of economic development boards and the like. There are all sorts of ways to actually get to them. And I don't know, Ed, what are some of the ways that you've gotten to individuals?
Well, I think everything that's been said notwithstanding, we started close to home. We started with our founding team, relatives, friends and family, people that trusted us, that knew us over an extended amount of time and were willing to take a risk and back us. And then that started to branch out where colleagues of some of the people that invested learned about what we were doing through their contact that was part of our group. And that's how it's kind of spread. But I think it really ties back into people that have some sort of a connection with you individually as a person, or they are quite familiar with the space that you're in. So they feel a certain level of comfort, and they're not generally professional investors that are just evaluating a deal on its financial merits. They're trying to get behind something that they believe in.
Yeah, and I think in some ways it's not that different from the way venture capitalists work. So, in my mind, especially now that angel investing is becoming kind of a more professionalized. Folks know what they look for, and in the VC space, it's really about who do you know who can vouch for you? Because ultimately, a lot of the technology businesses, they're really, really complicated. So as important component of that is, who else are you working for, and is somebody else on your team that they know can say, hey, this team and this individual is serious about what they're doing.
Well, and that's perfect. We're actually going to pick up with that specific point. Now that people know a little bit about what are the different types of angel investors and how do you get to them, the next question will be, once you actually go and have a meeting, how is it that you successfully actually try to raise this money? We're going to be right back with more Startup Insider.
This episode's featured sponsor is XL Partners. XL Partners is a venture capital fund that invests in seed-stage, high-tech, high-growth startups in upstate New York. XL Partners was formed in partnership with the University of Rochester and the state of New York. Currently, XL has approximately $10 million under management with a portfolio focus around life sciences, materials, energy, IT, and software.
Welcome back to Startup Insider. I'm Alex Zapesochny. During this segment, we want to start thinking about, once you actually get a meeting or get a connection to an angel investor, what is it that you should do to prepare yourself, to position yourself? And maybe just start off very basically. What types of companies are not really ready, or are not the types of companies that typically should be getting angel investing? And let's start with you, Mike.
Sure. Generally, angel investors are looking for something that has a fairly large potential exit. So things that don't generally fall into that category are, retail often, kind of single store retail isn't necessarily good for that restaurants. So it's generally, technology based of some sort, or technology enabled services. Healthcare, biotech are traditionally the types of things that angels can get much more excited about.
I mean, should you think of it as the types of companies that first you get angel investing, and then it's the sort of company that probably should be able to get venture capital funding after that?
That's generally the case. I mean, I think most angels are looking for the potential of having a home run. So it's like, okay, could it grow into a Google, Yahoo, a biotech company that may be acquired?
Well, and the other type of company that maybe isn't appropriate, and Ed, you're actually a good person, I think, to answer this question, the types of companies that are run a little bit more like lifestyle businesses, right? Because it seems like there's a very big shift from bootstrapping, paying for things yourselves, and then suddenly having other people to answer to. And how does that change life?
So I think to Mike's point, you want to have a business that can scale. It's got to have the potential either to, if it's going to be a restaurant, it should be able to franchise, right? There's a vision that there's going to be something big and grand in the future, and you need to be able to manage your company professionally. And I think when you take outside money, this is not grandma giving you a check to keep your company going and make payroll. This is somebody that's entrusting you with money with the expectation, the shared vision that it's going to turn into something bigger. So you have to take a much more professional approach to things.
Well, and Don, so in terms of typical deals, when you have to take this professional approach, tell us maybe a little bit about both the Rochester Angel Network as well as other angel deals you've seen. Typically, how big are these investments sort of per person or an aggregate? What are the valuations?
Yeah, so we've done something a little different in Rochester. The Rochester Angel Network is one of the better established active angel networks, certainly in Western New York and really in the state. We have about 18 investments, about $10 million invested since inception. We have about 65 members, and in fact, just a few months ago, we just closed our first formal fund. So earlier I mentioned most angel groups kind of every man for himself invest. Our community came together and raised a little over $2 million fund, where we actually can now invest as a group, where the fund would be the lead investor. And if an individual investor really likes the deal, they might have some money in the fund, but you can imagine any individual investment. In a $2 million fund, we might do 10 investments. So individually, you'll have a small amount of money in each of the 10 deals. If you really love a deal, you can write a sidecar, a check alongside the fund, a larger check. So I would say the typical investment for the angel group will be on the order of $300,000 to $500,000 in aggregate, and the fund helps assure that goes a little bit further. In terms of the kinds of deals that we look for in the structure, I think it's interesting to think about the progression of risk. So, I mean, angels, I would say, are kind of in the middle of the spectrum of risk taking. They're not really high risk takers. These are people who have made money the hard way, typically, and they're not going to write a check without a lot of hard questions being answered. So if you're a startup, one way to think about it is, well, if you're the entrepreneur, the first person who has to take the risk is yourself. You got to look in the mirror. You need to show that you have some skin in the game. People don't expect that you have a lot of money, but you have to have extended yourself to some level. The next level of risk takers are friends and family, as Ed mentioned, and you need people to convince people who know you well, who trust you, who followed your career, as Michael was saying earlier, and they think that you're gonna succeed, and they would be the next round of friends and family money. After that, we have a great asset in Rochester, in that we have Excel Partners, which is a seed fund, and they actually are mandated to invest in early stage pre-revenue companies. After you've raised that money, so it might be tens of thousands of dollars of your own investment and maybe on the order of $100,000 or so of friends and family, and maybe a couple $100,000 from the seed fund, that's when the angels would start to really get comfortable. Once you're starting to show traction, you have real products, you have a management team in place, the angel investors come in then, and when you're closer to revenue, and that's when you might be ready for a $500,000 investment, which would, as you mentioned, precede a venture investment eventually, a venture capital investment, if the company needs that. And many companies don't need to take that next step, but you certainly want to have the vision to go in that direction in order to qualify for our money.
So Mike, you've sat on both sides of that table as an angel investor and also somebody seeking that funding. What sorts of things, outside of the grandmothers and the close friends, what sorts of information do you actually need to present to them? And what are the things that an entrepreneur should be focused on?
Yeah, and I think nowadays it's very similar to what you'd need to present to VC. So it's kind of, two aggregate categories. One is, what's the plan? How are you going to get there? How is the amount of money that you're looking to raise going to make a significant difference to get to the next level? So it's the right, appropriate size of the raise. I think the other thing is traction, to close, whether it's angel funding, friends or family funding, or even VC funding. Folks want to see that you're continually moving forward. So you have to have some kind of a very tangible plan that over the next 3 to 6 months while you're seeking that funding, you can go back to the folks, every 4 to 5 weeks and say, okay, I got a new customer, I hired a new, engineering person who's working for equity. Once, we do the funding, we can turn them on full time. So it's really like a clear plan and some momentum that something's actually getting done. I think those are the two key components. I think too many folks who are seeking angel funding are just kind of there with a hat in hand saying, hey, once you give me some money, I can do something. Nobody likes that situation, because in entrepreneurship, sometimes you run out of money and you still have to keep things going. So momentum has to exist throughout the time period.
So Ed, you, as we've mentioned, have actually dealt with a lot of different angel investors from all walks of life. What are the things that you have found to be most successful in actually getting their investments, but also how is it that life basically kind of changes? What is it that you need to do once you get this money in? What controls, for instance, do these angel investors have over your day?
So a couple of good questions in there. I think first, the investors that we were able to attract came from the medical community because they are actually representative of the customers that we're trying to eventually provide a service and a product to. So they were familiar with the need, and they understood how we were addressing that need, and so they got behind it. They share the vision. I think we run our company as professionally as possible. I mean, obviously there are resource limitations. We're not Bausch and Lomb, so we don't have a finance department, but we have professional trained individuals that advise us in finance and legal matters, and we have to present this as a well-managed professional enterprise.
And so that means, and anybody feel free to jump in terms of the ways that life changes, you have to have annual meetings, right? Yeah. I assume you get calls, everybody gets calls from angels checking in. I mean, what are the other controls that they end up having on you once you take that step?
I guess the other thing I wanted to make sure there is it's an ongoing relationship. So in many of these ventures, you need to raise money several times over. So I think it's critical that you continue to keep a very open dialogue with the angel, because you may need to go back there and say, okay, we're looking at raising another 300,000-400,000. I think the other one, which you asked about, is the controls, and to a large degree that's determined by what type of legal agreements do you sign, or is there board representation? Not in the smaller angel deals, usually not. In the larger angel deals, there may be board representation that takes place.
I would also just add that we, as we're talking about this angel investing, and there are sources of money for entrepreneurs, but I think it's important to make clear that there's not a single source of money that's easy to access. Really?
Yeah, yes.
Well, whether you're asking...
If there's one thing that people take away from this particular episode, I think that has to be...
Well, the fact is, people are parting with their own money, and they don't do that easily. So whether you're asking your grandmother for a check, or you're asking the seed fund, or you're asking the angels, or the VCs, there are lots of barriers to getting that money. And usually, they're a good sign of whether you have a good business or not. So if you're not getting the money, a good place to look is in the mirror, and make sure that you have a strong business plan. Make sure if you're not answering the difficult questions satisfactorily, then there's probably a problem. And just to quantify that, I would say that the angels across the country are funding on the order of 1% to 3% of the deals they see. And they don't, and that's after some preliminary screening of things that are really garbage. But if we see 100 deals, we might do 2 or 3 investments.
Well, and that's actually, it will take us to our next segment, because it brings up another point. Even when you're part of that successful 1 or 3% that's actually managed to get some angel investment, that does not mean that everything is necessarily great moving forward. When we come back after this break, we're going to talk about what are the ways that you can basically make a mistake in actually raising and getting that money. We'll be right back.
This program is sponsored by Complimar Partners, a market-leading provider of fulfillment and contract packaging services, kitting and assembly, distribution, e-commerce, direct mail, print, and reverse logistics solutions. With over 70 years of experience, Complimar enables its customers to reduce cost, lower inventory, and improve performance. The Technical Entrepreneurship and Management program at the University of Rochester. The team's master's program is for business-savvy engineers who want to go beyond invention. The program can be completed in as little as 1 academic year. Part-time study and merit-based scholarships are available. And the Entrepreneurship and Innovation Working Group of the Finger Lakes Regional Economic Development Council, building the Finger Lakes entrepreneurial economy.
Welcome back. I'm Alex Zapesochny. During this segment, we actually want to talk about something that's really important. In many ways, this is maybe the more advanced discussions for the entrepreneurs who are already in the process, perhaps, or are going to be getting more angel investment. The name is angel investment, so you would think that somehow very benevolent people are going to descend on you, and no matter what happens, they'll just keep smiling and giving you money. But there's so many different ways to mess this process up. And I'm not starting with you because you've ever made any of these mistakes, but let me start off with you in this segment. A very common one is valuations. Tell us about what are the common problems that people have when they get angel investments and value something.
Well, I think you need to make the point that you can't confuse this with charitable giving, right? This is not a donation to your company, although maybe the criteria might be a little bit different, and there may not be the same level of sophistication that you might see with a top-tier venture capital fund. There's an expectation of a return. I mean, that's the reason that somebody's trusting you with money. So I think in that context, you might do yourself a disservice if you set that investment vehicle in such a fashion that it becomes an impediment to future follow-on rounds. So you could set a valuation that's too aggressive. You're a small company, there's not a lot of track record. Maybe you're in an innovative space where there are not a lot of comparables. So you pick a valuation and you try to stick to it. But if you follow that up with another professional round from VC, they might have a lot of difficulty supporting and sustaining that valuation or even an additional valuation given the milestones that you've been able to hit. So in that case, you're answerable to your angel investors, and you might have to go back and say, well, I know we said that this was worth $5 million, but really, we're going to have to raise some more money, and it's going to be raised at $2 million. So, they're taking a little bit of a bath there. Or you have to correct that with your angel investors, which ultimately hurts the founding team more because you're giving up more of your company to make everybody whole.
Well, and that's really the danger, isn't it? Because the types of individuals you deal with at the angel network, they're sophisticated individuals. So if you disappoint them, okay, they'll take that professionally, not well, but professionally. But there's so many. But you can pretty easily confuse people that that just know you or just know the industry with valuations that are taken really from thin air. And it really is one of the most common things that you hear as being a problem. Either one of you wants
I think the typical mistake will be, just as Ed mentioned, I mean, you'll tell your grandmother how much the valuation is, and she won't ask a lot of questions, and I don't mean to pick on anyone's grandmother, but your friends and family aren't going to push back so much on the valuation, they'll take your word for it. When you go to the angels, they will push back on it, and that's when you'll confront that first scenario where you sold the first stock at $5 million valuation, and the angels say your company's worth $2 million. Right. And now you have some explaining to do, or you're going to have to reconcile that to keep your friends and family whole, which is the right thing to do. Yeah. But it changes your cap table and your level of ownership. So you'll end up after the fact selling more of your company than you thought you sold up front. So it's a challenge. But to just quantify and keep it simple, at the angel investment stage, the angels are looking for a 10x return in 5 years. So you need to have a credible story about your growth projections, about your valuation, about the whole package that gives them confidence that they can get a 10x return on that investment within a 5-year window. Right. Now, are they going to? Who knows? But that's what the story has to be able to reflect in a credible way, and they're going to test you on that as you try to get money from them.
Well, and this "who knows" is a really important element of it. And Mike, perhaps you can answer this. There are professionals who understand that startups, it's basically it's a portfolio idea, right? You're going to take a small percentage of your net worth and you're going to put it into these highly risky investments, and you're going to know that only a small number, 1, 2, 3, if you're extraordinarily lucky, will become successful. But a lot of the angels don't know that, and so how do you deal with this problem?
No, I think it's an important one to hit kind of focus on because of two different reasons. Oftentimes, there are individuals who get very excited about your business, especially if they're related to you. So you have to, kind of sit down with them seriously and figure out how much can they comfortably invest and potentially lose. The other thing which is very critical is, through the life cycle of a company, usually there's multiple raises. So you have to be fairly open to the investors that there may be a B, C, D, and E round, and would they want to actually save some dollars on the sidelines to participate in those rounds? Because this is really, most of these successful, exit stories, they're really more like marathons than sprints. And usually the first-time entrepreneur thinks like, hey, I'll do this for 2-3 years, then it's going to, take off. Usually it's, 7 to 10 years.
Well, and I want to make sure that people understand what you're saying when you say that there's going to be B, C, D, and E rounds quite often. What you're really saying is that the phone will ring, and someone who maybe thought a project would go through or a customer would come through and now it hasn't is telling you, by the way, please everybody send $12,000 more dollars in order for us to have 3 more months of payroll. That's difficult, especially if it's friends and family or grandma or
And it's especially difficult if that individual's written a check that already pushed the limits of what they were able to do. So it's much better to say, okay, you want to invest 50, but in your situation, I'd really recommend you put in 10 or 15 because we may need some additional down the line, and have that type of a conversation. Because then, if that situation does come around, then nobody's surprised that there's an extra 10 or 15 that needed to be invested by that individuals, and especially if there's good traction with the company, they may be very interested in putting more money into the company as well.
Well, I think the other thing too, the dynamic is the earlier you're in, generally the better a price you get. So you're trying to balance all of those factors, and it's tough to tell somebody not to give you as big a check as they seem prepared to write, for a lot of the reasons that were discussed. But you can let them participate, and from a selfish perspective, if you can delay them for a little while, then that may be better for you as a early shareholder.
And on top of that, because this is a longer-term prospect, if you have a happy angel investor, they'll tell about their experience to other folks. So the likelihood that they'll bring other investors into the fold is much higher if you've really managed the expectations, both in terms of how quickly you'll be able to build the business, as well as what amount of capital may be required over the lifetime.
And I think that part of that, and that's a very interesting point, is that most of the people who are entrepreneurs are serial entrepreneurs, right? So it's not just about getting money for that particular company. Odds are, if you're a serial entrepreneur, there's a good chance that something doesn't work out. You've learned a lot, you figured something else out, and you're going to come back to them. And if you haven't done the expectation setting appropriately, and I think that's where you're really getting to, you're going to have a very tough time, and you're going to have to be ducking people at the local Wegmans or Tops or wherever it is you go. And there's a real human cost oftentimes to entrepreneurs when they don't do this process correctly.
Well, there's a couple things. The more time that goes by, the more data you have to evaluate whether things are headed in the right direction, so that when people are ready to write the next check, they can look and see if you've hit your milestones. Have you followed the path that you described to them? Maybe you're ahead of the curve. Maybe you're getting places faster, and you're doing better than you told them. So they feel less risky to write that second check. And obviously the home run is you do so well that people just pledge you money before your next venture, right? There are stories of venture capitalists who will just sight unseen, if this person is going to start something, I'm in, right? Just because they've got such a good track record and they trust them that deeply. And
I think that one thing that should be understood also is a lot of friends and family investment. You'll be able to develop relationships, and they'll stay with you for future deals, et cetera. Once you go to a more institutional-like investment, whether it's Excel Partners at the seed stage or the Angel Network at the angel stage or VCs, it'd be great if you know the individuals, and it helps an awful lot to get a warm introduction and trusted people to introduce you to the groups. But ultimately, they're going to have a much more objective process when they evaluate you. And as an angel investor, you end up, as I said, you turn down a lot more deals than you accept. But part of the whole network is to support the community and help the people who didn't get the money, help them succeed. So there's a real obligation, we feel a real obligation to explain to them why they didn't get the money, and even offer them coaching. There's 65 people who want to be in this space. There's likely someone who can help the company succeed. But to be clear on what the angels and institutional investors really look for, there's a few things that they're universally looking for. They're looking for, first and foremost, a strong leadership team, someone with that track record who's done it before, someone that has real credibility. They surround themselves with good people. Ultimately, you're writing a check and you're handing it over to the CEO, and that CEO is going to make a lot of discretionary decisions, and you have to trust that they'll make good decisions. Even if you're on the board, they're running the company. Next, you have to be addressing a sizable market, a market that's big enough. And that's why restaurants and lifestyle business often don't have the ability to have a 10x return. They're just not addressing a big enough market. Then the next thing you really have to make sure that your business plan and your story shows is a strong value proposition to your customer. And you have to be solving a real problem. A good rule of thumb is if you have a product that's better than what's out there on the market today, it's got to be 10 times better, not 2 times better. It's got to really be an order of magnitude cheaper or faster or lighter, whatever the benefit may be. And then it's nice to show your investors that you have some kind of competitive advantage. So you'd like to have patents or a big head start or proprietary software, something that would be really hard for anyone else to copy. If you go into investors with a strong story in those 4 categories, you have a pretty good chance of getting money. It's easier said than done.
Yeah, and I think along those lines, it's ultimately, whether it's the VC or the angels, they're really investing in a team and a person. Because all of us know that the environment changes, decisions have to be made. The story has to hold entirely together at the time when the check is being written. But I think an even larger criteria is, can this CEO and this team pull it together? And I think most of the time, I know a lot of people talk about there's not enough capital in this region, but rarely do I see a very strong team not getting funded. So I think it's if we continue to coach more teams to become strong teams, I think that addresses a lot of the capital.
And that's a great place to leave it. So as Don said, it's really difficult to get money, but but we do it. When you find really good teams who have a great idea, who've set the right expectations, for the most part, this community has money for those folks. And this has been a really great discussion. And as I think those of you who have been watching have realized, there's a lot of complexity to angel investing. Not only getting the money, but also making sure that when you do get it, you're thinking about it in terms of how to handle that money. It really is the time when many companies are really thought to have finally grown up. To go from a few folks in the garage to really having responsibilities toward others. So hopefully this has been helpful to all of you, and we will see you on a future edition of Startup Insider.